Good afternoon, everybody, and welcome to another ShareSoc company webinar. My name's Mike Dennis. I'm one of ShareSoc's directors. I'll be your host for this particular webinar. Today we have Pembroke, the VCT, speaking to us, and shortly I'll introduce you to Andrew Wilson, who's the CEO and CIO for Pembroke. Just before we get going, we will now post a poll, and I'd appreciate it if you could just let us know whether you're already an existing shareholder in Pembroke or whether you're not. We'll just give you a few seconds to fill that out, respond before we carry on with the show. One or two more of you to go. If you can find the button, I appreciate it. I think there's still 3 or 4. If you've found the button to press. Okay, thank you for that. We have 43% of you are holders and 57 obviously are not. So we're obviously interested in coming along today to hear more about Pembroke. So just the usual warning that ShareSoc is not authorized to provide you all with individual investment advice. So what you hear today is purely your choice as to whether you decide to include Pembroke in your respective portfolios. And I'm sure you've all seen that before as regular members of ShareSoc, so I won't bore you with all the details. Next slide, please, Amanda. And again, there are 1 or 2 new names I haven't seen before in the attendees today. Just a reminder, we are a not-for-profit organisation, so we're very different to maybe some of the organisations that do these webinars for investors, and we are growing quite quickly. We've got around 7,000 members now. A lot of the work's done by unpaid directors like me, so we do appreciate it when you pay us your annual subs. So if you're at the moment a free member, please do upgrade. All the money you give us, and it's only 90 pence a week at the end of the day, we will spend wisely on your behalf. A lot of it is spent on campaigning on your behalf, both with government and regulators, and occasionally with badly behaving companies to try and get your money back or whatever it might be. And we do have a fairly good track record of success trailing behind us in the 7 or 8 years since we were first created. And we'll continue to do more of that as you give us more funds to do it with. And as you can see, a whole list of other things that we do on your behalf. Next slide, please, Amanda. Now, in terms of the technology, I guess most of you are familiar with it, but to ask a question, please click on the Q&A box at the bottom of your screen and type away. And we will get through as many of those as we can after you've seen Andrew's presentation. We're doing a slightly different thing that you may not have seen hitherto, but we've tried it now a couple of times. It seems to be reasonably successful, is that you get the opportunity to see all the written questions coming in and you can vote on them. So if you particularly like a question and you think you'd love to hear the answer, please give it a vote. And that helps me in sifting through the myriad questions that come through and try to give our attention to the ones that are, in your view and in the audience's view, most important. So please do remember, after you've clicked on you've submitted a question, go look at the other ones and try and vote for the ones that you think are going to be the ones that attract the most attention from the audience, etc., and you'd be most interested in. And another reminder, the Stockopedia report is available. You should have had that on a link for the reminder email, but also it's in the chat box on the toolbar on your screen now, if you haven't seen it before. And there will be a copy of the presentation pack in our website after this event, so you can always go back and have a quick look at anything that you missed at the time. The other thing is, remember, feedback's very important, not just to us, but to the presenting companies. We always read through all the feedback and we make sure presenting companies know of any comments, ideas, questions that you may have, so that they can take that away and chew it over. And we sometimes got some extremely interesting and insightful ideas and comments through that route. You will have already received a link to that feedback system, so you can fill it out now if you wish whilst you're going through the presentation. And you can also find a link in the chat box as well on your toolbar. So, Andrew, welcome to, I think, your first ShareSoc presentation, and hopefully not your last. Be interested to hear what you have to say. VCTs are quite an interesting area for our members in general. So we do have several hundred members who have already hold VCTs and understand how they work. So I'm sure they'll be interested to hear more from you now. So welcome, and over to you.
Thank you very much, Mike. Welcome everyone, and thank you, Amanda, for organising this. Now I'm going to share my screen. Hopefully this will work. It worked in our practice. Hopefully you are now all seeing a slide that says Pembroke VCT with some nice pictures of the brands we've invested in. I'm going to talk about the VCT and the current offer we have out at the moment. I will circulate through ShareSoc this presentation afterwards, so don't worry if you do miss anything. You'll get a copy of this, and hopefully I will be able to answer most of what you're going to ask me tricky questions on. But I think probably the best place to start is why? Why did we found Pembroke VCT back in 2013? And I don't know if any of you know Peter Dubin's Oakley Capital. Oakley Capital are a successful private equity fund. They currently have 3.5 billion under management. I joined Peter, who was a long-term friend of mine. In fact, he gave me my first job when I was 20 years old, which was some time ago. I joined Peter back in 2009 when there was sort of, there'd been global meltdown going on. And I went into his office, and I was looking for a job, and he said, well, I've just bought some businesses, Tom Aiken's restaurants being the main one that I was working on, so you can come and run that. And I went and I ran Tom Aiken's, and we got successful with that, and then there were a few others. And the more we did, the more opportunities came into the office, such that we needed a structured fund to invest in them. So we looked at EIS, we looked at VCT, and we thought we would set up a VCT. So back in 2013, we did that. We raised our first funds through friends and family, where we raised just shy of 20 million, which really gave us the money to go out and show that we had an investment strategy. We were consumer focused. We liked investing in wellness, in food and beverage, media and design. Since then, we have added 2 new sectors into it. We've added digital services and education. Currently, we've got 117 million of assets under management, and we've got a portfolio of 37 companies that have all shown great promise, and we're looking forward to working with over the next few years. So how have we performed? Now, I find fund performance very difficult to really talk about in any sort of with any sort of credibility, because actually early stage businesses, as we all know, are very, very difficult to value, and they're worth what someone will pay for them. So we always take the decision to value our assets very conservatively if they're doing well, And if there's a little bit of trouble, then we like to value them down quite quickly. We can always write them up at another stage, but we very much manage in real time how we look after our NAV. Our rough rule of thumb is that during the first year of investment, we will hold something at cost and then we will revalue it. But we tend not to, or in fact we don't, write in large upswings into our NAV, because as quickly as they go up in an early stage business, they can come down. So, I mean, this really shows our sort of total return, that is assets, cost of investments and dividend paid, and uplift over the period 2015 to 2020. The latest September one showed a further uplift to 124.1 pence. So it shows a gradual uplift, but as I will demonstrate later, one of our investments that we have just sold, Hackney Gelato, sorry, not Hackney Gelato, Pastor Evangelists, was sold at considerably more than we had it valued at. We'd held it for a year. We knew that there was interest in the market. It's a food delivery business. It was a very hot space during COVID, and we exited at a considerably higher return than we were carrying the value at. So although these graphs are very important, they don't necessarily paint a real picture of how the underlying companies are performing. Onto our team, and I think here I'd like to talk about how we have developed the team, and that really stems back to when I first set it up. It was me and an analyst named Tristan, and I realized there was a problem. He was a great analyst, but when he was carrying out due diligence, which obviously requires your full undivided attention, if we had a problem with one of our portfolio companies, he'd have to drop the due diligence and go off and look after the portfolio company while I went and saw new businesses. So it was very clear at an early stage that what we wanted to do at Pembroke was set up a team which was solely focused on investment, and then a team that was solely focused on portfolio management. So we've got Simon Porter, who heads up our investment team, very capably, joined by Fred Ursel. William Goodwin is our portfolio director, who's been with me since 2017, 2018, and Orla works with him. And then Chris Lewis, who some of you might know is from a VCT background, was at Downing for 10 years as CFO of Downing. He joined Pembroke back in September 2019, and looks after a lot of the sort of government, the governance side. And then we got Katrina Litton, who joined our portfolio team in early 2020, who works closely with the underlying portfolio companies with me, and Ellie, who looks after us all with great aplomb. Our board and investment committee, Peter Dubins started off on the board, and he also was on the investment committee, and we felt that he was too conflicted, so we put him into an advisory role. It was very difficult to have deal flow coming through him and him also sitting on the investment committee. So Peter is still very aware of what we do, all the companies we invest in. He's an integral part of our strategy, but he's not involved in the structured governance of it. The Pembroke board, Jonathan Ginogly, Lawrence Blackall and David Till have been with us since inception, and they have recently been joined by Louise Wolfson, who I might add is not a nepotistic appointee, same name, no relation, and Mark Stokes. And then moving on to our investment committee, and here is something that we also do rather differently. I heard too often in the early days of sitting with portfolio companies and having other VCT or EIS funds with the investee companies pitching to them, I heard too often, having gone through a long due diligence process, after 2-3 months, that the investment committee said no, with really very little other explanation than it's just not right for us now. So it was something that I wanted to do at an early stage, is change the way our investment committee works so that it is very much founder friendly. And what we do is John Payton and Ruth Kennedy, who are our 2 main investment committee members. John is chairman of the I Group and is probably single-handedly the person I respect most for his understanding of data and digital commerce. And Ruth Kennedy, who is a branding expert. They're both currently involved with business, and they love business and they love meeting founders. So I thought, well, why don't we introduce the founders direct to the investment committee? And it's actually worked really well. So the way we run our investment committee is that me, together with the team, appraise all the opportunities we see. Then we write a brief note to the investment committee, asking them if there's any reason that we shouldn't be taking this into further due diligence, to which they normally come back with a no, carry on, looks sensible. We then carry on doing the due diligence, and at the point where we're comfortable that we're going to present it to them, we actually get the investment committee to meet with the founders and management teams. And that serves 2 purposes. Firstly, as we always say, we invest in people, not in businesses. Well, if we invest in people, it's very difficult for the investment committee to make a decision on why we're doing something unless they actually meet those people. So it works for our investment committee, who understand far more than we could possibly get through in writing a document. They understand far more about why we're investing in these people and why we feel that these people are the ones who are going to deliver their business plan. But also, it allows our founders, it allows them access to 2 really lovely people who are involved with businesses who they'll be able to bounce ideas off. So actually both parties gain a huge amount out of it. Once we then pass that hurdle, we take the process through into full sign-off, which is full investment committee memo. That all gets signed off by the investment committee, and then we go ahead and transact. And at that point, the investment team, who have been working hard on the due diligence, hand over to our portfolio management team. And that's the way we run it. And at the moment, it works very well. It has done since 2018, when we set this structure up. So in 2020, as I said, Chris Lewis joined us, and we had a restructuring of the way we had been set up. And I'd also like to thank Cliff Waite from ShareSoc, who listened to our proposals, gave us very, very good feedback, and I think was genuinely supportive of what we were doing. First of all, we merged our share classes. We used to have 2 share classes, an A ordinary, which, as I said earlier, was the initial shares that we did a friends and family funding round in. There was no point in us having 2 classes of shares, so we issued B shares for those ordinary shares, giving us an AUM of £100 million in 1 share class. We also went through a big restructuring of our performance fee, which, when we entered the VCT market, because we didn't really have an understanding of how VCTs operated, our performance fee just actually was not fit for purpose. And the reason it wasn't fit for purpose was because actually, once we had returned the investment, we would have been able to take a performance fee on loss-making businesses. That was the way it was written. It wasn't fit for purpose. So we decided to change it and write something that was fit for purpose and aligned the management team with our investors. So we've got a very simple performance fee structure where it's based on actual realizations, not on NAV-based realizations. So If we make money, if our investors make money, we make money. If we then lose money on an investment, which can happen in the space that we invest in, we have to make good that money before we make any further money. So there is permanent catch up, which means that we're always scrutinizing ourselves as to whether we should put money into a business. And if a business does start to go wrong, should we put more money into it to get it over its problems? Or do we have to take the tough decision to not continue funding it anymore? I might say that if our performance fee was based on a NAV, then it might be worthwhile us continuing the investment, even though we had lost an element of confidence in the portfolio company. We've also made a big shift to doing everything online. We've redone our website. We've got online valuations, online voting. We're much better on social media, or I like to think we are. I hope those people who are investors follow us and engage with the content that we're putting out there. So onto our current offer, we are raising £40 million, or hoping to raise £40 million. We launched the offer in September. We have so far raised just shy of £7 million. There's access to 37 maturing portfolio companies, and we target a 3p dividend plus special dividends as and when we get them. So I touched on earlier the Pastor Evangelist exit that returned 4.6 million. We invested 2 million. We sold it for 4.6 million. We're returning that 4.6 million by way of a 4p dividend payable in March. So it is our intention to invest, grow, exit, and return money. The other thing we do is we have a very clear fee structure, and our fee structure works for us. I think it works for our investors, and it definitely works for our management teams and founders, in that we don't charge any fees onto our portfolio companies. And why that's important is that if we're investing, which we predominantly are in this space, in pre-profit businesses, if we charge those companies a monitoring fee or an arrangement fee or director fees, then all we're doing is putting money in to get paid our money because they're pre-profit businesses. So it's our investors' money paying us a higher fee, sort of through the back door. So it's a practice we don't get involved with. We charge a 2% management fee, and that 2% management fee pays us to manage a fund, which means we make investments, we manage portfolios, and we help the companies exit. That's what we do. It's very simple, very clear, and we like to think transparent way of us doing business. So onto our portfolio. As you can see, the circle in the middle is our sectors, and I'm sorry this screen is somewhat full of brand names. But I think what's important to do is to look at firstly the sectors we're involved with. But I'm actually going to go on to another slide which shows this broken down into investments pre-2018 and post-January 2018. And the reason for this is that we very much get labeled as a hospitality and fashion investor. And that was the way we were set up. When we were first set up, those were the opportunities we were seeing. Over time, we have become an investor across a number of other sectors. And I will now move on to this slide, which really shows the 2013 to 2017 investments, where we invested a total of 51 million. Now, interestingly, those 51 million are now valued at about a 30% uplift. Looking at our post January 2018 investments, we've invested 30 million, and those have a 39% uplift already. So we've invested in a slightly different type of company. And also what you'll see here is the blue sector on the first graph, on the left-hand graph, has completely disappeared. We haven't made a new fashion investment. We have continued to make investments in our fashion companies that are doing well. but we haven't made any new investments in fashion. Likewise, if you look at the hospitality sector, we haven't invested in physical spaces, we've invested in food brands. Hackney Gelato is a fantastic ice cream brand. Rubies in the Rubble is a sustainable, eco-responsible mayonnaise and ketchup brand. Pasta Evangelist was a food delivery business we exited, and Secret Food Tours unfortunately is closed down while tourism is not happening, but it will come back at some stage. The sectors that we really like at the moment are education and wellness. And again, you look at the wellness sector here, back on the left-hand side, Kicks, KicksU, and Boomcycle are all physical space gyms. Thriver are an at-home blood testing kit that helps consumers monitor their health by way of an app. Lima is an incredibly advanced, medically evidenced nutraceutical vitamin pill, for lack of a better word. And Eve is one of our new investments, which prevents occupational hearing loss in construction sites, oil rigs, and anywhere where there are excessive decibels. So as you can see, we've shifted our wellness away from a fixed four-walled environment into actually consumer wellness. And then education, we think, is a really exciting sector. And the reason we like education is that, and I've been involved in education in a number of ways for the last 25 years of my life through charitable initiatives. There's a very interesting thing with education, which COVID has highlighted, is that actually education is great, we educate our children, but the measure of education is not necessarily any longer fit for purpose. And the reason I say that is because having an exam result is a purely selfish measure of how much data someone can take in to be able to regurgitate it and churn it out in an exam format. Now, when we look at the modern employers, what are modern employers looking for? They're not looking for people to sit there and work selfishly. They're looking for team building, they're looking for collaboration, they're looking for outside the box thinking. And so we've got an education system which the measure of success is a solely selfish measure, and we've got a workplace which is demanding a different set of qualities from the people it's interviewing. So we feel that education is going to be an area that changes dramatically over the next 5 or 10 years. And I think COVID has sped that up. It's not just about whether you can teach someone remotely. It's far more than that. It's how do you actually assess people? How do you assess young people so that they've got a learning record that is appropriate for the workplace and that can push them down a channel that they are going to end up with employment? Surely that's what education should do ultimately, is prepare people to be able to be employed, and all the other soft skills around it. So we're going to continue investing in wellness. We're going to continue investing in education. Food services are very exciting. Digital services, we're seeing a lot of opportunity at the moment. And our media section, Popsa, I don't know if any of you have ever made a photo book. Popsa was a great app and really highlights how Pembroke like to conduct an investment process, which I'll just touch on for a little, is we like to do this concept of stepping stone investing. I and my team don't like 5-year business plans that says we're going to build a company worth 100 million in 5 years, because what you need to do is you need to build a company worth 5 million in 1 year, and then you need to build a company worth 15 million in 2 years. And what we like to do is we like to invest an amount of money that focuses founders and management's time and efforts on delivering that period of growth that we're funding. If they do that, we'll fund it again and again and again. So we'll slowly add to our stake, but we won't take the risk of putting a large amount of money in on day one into a business, which we want to get to know them before we start committing large amounts of our investors' money. So Popsa, which, as I say, is this photo app that allows, and I'm not particularly good at tech things, but when I tried to create a photo book before I found Popsa, it took me about 2 hours of dragging and dropping photos from the cloud into a book on my PC. What Popsa does is it is built for mobile. So the photos that you take on your phone, you then just touch on the ones that you want to put into a book and it builds the book for you. And you basically have a book within 5 minutes. They recently got listed by Deloitte, Tech Top 50 fastest growing tech companies. They came in at number 3. We invested the first time we put in £1 million, second time we put in 1.5 million, and the third time we put in 2 million, slowly increasing our stake as the company gets bigger, thereby de-risking the amount of money that we put in at a lump sum. So it's very much we like to get to know the company better before we continue funding things. Moving on from this, I'll run through our new investments and follow-on investments. Since September 19, we've made 10 new investments. Obviously, in 2020, it was difficult to make investments. We still managed to do it. The one thing we said is that we won't make any investments until we can physically meet people. So we carried out due diligence at the point where we could meet them. We went for socially distanced walks in the park. We met for coffees. But we wouldn't make an investment without actually seeing the whites of people's eyes. We've deployed 10 million in new companies. We've got another 5 million in due diligence, and we've made 25 million in follow-on investments, really fixing our strategy of continue to nurture our stable, but not giving them too much money. We also feel that founders work best when they don't have spare cash to worry about. They really deliver on what they say they're going to deliver on and don't go off on tangents trying to buy revenue, because cash is basically accounted for as to what it's going to do. We will continue this strategy with our new fundraise. Here's a little slide on our Pastor Evangelist exit. We were invested for a year. We actually first saw Alex Savelli, who was the founder. We first saw him back in, I think, 2017, maybe 2018. And we didn't like the fact that he just had a one-channel business. It was just pasta through the door, and it was loss-making. And we thought, well, the more pasta you deliver, the more money you're going to lose. So we said, we'll invest at the stage where you have an omni-channel offering. They went out and they got dark kitchens, and they did a concession business with Marks and Spencer's, and they set one up in Harrods, and they set one up in Selfridges. And at that point, we said, we'll invest, which was in January 2020. COVID hit in February, March, and obviously concessions closed down, online business flew, and they got an approach from the biggest pasta company in the world. One of the journalists wrote that it's like selling ice to the Eskimos, selling a pasta business to Barilla. So we were very proud of that one, but obviously that's not the norm for holding a business just for a year. A lot of people talk about what they do. How do we add value? Well, the fact is we don't have a one-size-fits-all model. What we do is look at every investment as a totally unique opportunity. And we very much work with the founders as to what do the founders want from us, and therefore what can we provide. So we know before we invest what we're going to be able to bring to the party. Now, one of the areas that we find founders of relatively early stage businesses are not very good at, on the whole, is getting the right people in before they really need them. And what we try and persuade businesses to do is don't have people at business school at our expense when you could turn around and hire the right people who hit the ground running. And now in all of our business, we work very closely with the founders and management teams on making sure we spot the gaps in the business so that we can fill those with the right people. And that invariably saves time and therefore money. Now, there are no certainties. One of the things we do in our attempt to be entirely transparent is in all of our literature we produce, our half-yearly report and our annual report, we list every company we hold an investment in, not just our top 10 holdings. Some don't work out for various reasons, but that's the nature of where we invest. We obviously try and get the best result we can, but in some cases, we have to stop funding because we have lost confidence in the business going forward. And at that stage, it's a tough decision. You know, it's not easy working with founders and their management teams when it doesn't work out. But we have to occasionally be tough. Where we can, we like to then restructure it so that we have something going forward. In the case of Chuck's Bar and Grill, we've still got a stake in it, although we had to refinance the previous business. We can no longer invest in the business, but we have 25% of the entity going forward. And I'm pleased to say that when we did come out of the first lockdown, we were having record months as consumers wanted to get back out there and eat. And I think that's one of the fundamental differences between the first lockdown and the second and the third lockdown is during the first lockdown, the media were very much in our minds saying, well, of course, travel will never be the same and no one will go to a restaurant again and no one will go to a gym. Now, the reality is with our restaurants, when they were allowed to reopen on July the 4th, it was literally like turning on a light switch. You open the doors and people flooded back in, albeit in a more COVID secure and slightly less tables. And funnily enough, actually, the big difference that COVID brought on in the hospitality industry, and I think also in the gym industry that kicked back into play in August, on August the 5th, was that there was a lot more mutual respect. There was mutual respect from customers being thankful of restaurants being open and being much nicer to staff, and staff being much nicer to customers. So actually it had quite a positive effect, and I certainly found restaurants to be a more friendly place and somewhere to enjoy time more. And so this lockdown, although it is an inconvenience, it's not a concern that restaurants won't come back. As and when they do, we will open up and we will continue to serve our customers. On the deal flow side, we've seen fantastic deal flow. As you can see by this graph, the 2020 meetings was the highest number of meetings and the highest value in millions of deal flow. We saw about 1.3 billion pounds worth of deal flow during 2020. And we continue to see great deal flow now. That's our pipeline as to how it shakes out. We had 488 approaches, held 123 meetings, made 8 new investments, which are listed down the right-hand side. We've exited one of those. The others we're all really excited to be working with. We've got 3 new investments in due diligence, and we made 18 follow-on investments. Onto our charges and fees. They are pretty standard. On the early bird side of things, we've still got 0.5% on a remaining, I think, just over 3 million pounds of subscriptions received. Annual management charge is 2%. And again, we don't take any fees from our portfolio companies. And we only pay a performance fee on actual net realized gains with a makeup for any losses that we might incur. Our timetable is as it states. We pay an annual dividend in October each year. We'll aim to do the same this year. We have a cut-off of April the 1st for applications. And in March, we're paying, as I said, a 4p special dividend, which was from the Pastor Evangelist exit. In the prospectus, these are the important pages. I won't read those out to you, but if you want to peruse our prospectus, that's where the pages that you might find interesting are. And our disclaimer. And I think I'm probably meant to stop sharing there.
Right. Thank you, Andrew, for a whip through the situation from Pembroke's point of view. Whilst you've been talking, we've had a few questions dribble in, and I've also got some pre-submitted ones in front of me. So I'll try and crack on through them, and where there seem to be duplicates, try my best to combine things. Just one about the directors to start with. One of our members said it's good to see that the directors have some skin in the game in terms of shareholding at the moment. Do you yourself have some skin in the game?
I certainly do. Do I have to say how much?
Well, I don't know whether it's published data, because you're not a board member, are you? So it's probably not in the accounts, is it?
I don't think it is in the accounts.
But but we can take it as read that you've got some. And will you be taking part in the fundraise this year?
I already have done.
You already have done. That's good. Do
yes.
you know if any of your board members have done so as well, by any chance?
Some of our board members have. The two new ones haven't yet had the opportunity to, but we will be sitting them down and encouraging them. And some of my management team have as well.
Okay, no, that's good to know. It's top of the list for most members to check that box before they go any further. In terms of the COVID impact, you've touched on this already. Are there some businesses still in mothball mode at the moment, with the lockdown, presumably in the hospitality sector? And you expecting all of those to come back to life at the appropriate moment? There's nothing that's sort of dead and buried at this point.
No, I mean, the hospitality and the gym sector are currently trading by doing, the gym sector are doing online classes. We've obviously negotiated with landlords. We're not paying rents, we're not paying rates, we furloughed staff. So actually the government have been incredibly generous and supportive of trying to protect employment and protecting businesses, which I think obviously we're all thankful for.
Yeah.
With regards to the travel industry, we have two investments, one called Hotel Map, which is a fantastic business that basically streamlined the hotel bookings for large organizers, large corporates going to conference centers. So it was a sort of platform to be able to manage your staff and book your staff into hotels. And they'd signed up 385,000 hotels with no sales team by doing a deal with conference centers who were going to be suggestive to the people who booked in that they used Hotel Map as a booking platform. So everything was going fantastically. They then, obviously, conferences shut down. They are now starting to come back in Asia, encouragingly, although with very little foreign travel. It is mostly local travel. But interestingly, what they've done, and this is really about the quality of founder, is that rather than sitting there and saying, well, let's mothball and furlough ourselves, they said, well, actually, how can we make our product better? Because when we do come back, we need to engage in the B2B market and the B2C market. And they've now developed a whole load of new products that as and when hotels open up, they've used this time wisely and actually worked hard to better themselves so that when they come back, they're even stronger. And I think that's the exciting thing, is that we've had one business that has failed. It was a relatively small amount of money. We put in 650,000 in total. It was a business called Style Index that looked at streamlining the way the fashion world would organize its content and models and photo shoots and what products were shot where and when, and it basically kept all that on a single platform rather than give that power to the creative director within the fashion brand. So we were talking to a lot of fashion brands. Obviously, when COVID hit, the photo shoots stopped. People just didn't behave in the same way, and people now, fashion brands now have realized there is a different way to do business. It's about getting product quicker into an online world rather than putting it necessarily into glossy. So yes, we've had a casualty, but with regards to hospitality and travel, we've also got secret food tours that was mothballed. It costs us £6,000 a month to continue running it, and as and when they come back, they will, people. I think there's going to be, consumers want to engage again, and that's what was shown when we came out of the first lockdown. People want to get back to not normal, but we want to do things. We want to have experiential things in our lives again. So, as and when we can come back, we will. So yes, it's been a case of mothballing, but at the same time, making the products better.
Okay, thank you. Just in terms of shareholdings, some of our members have noticed that Ruffer LLP has appeared on notifications in the past as having a significant interest in Pembroke VCT shares. Can you explain the nature of the relationship between Pembroke management and Ruffer, if there is indeed any? And are you aware if Ruffer have similar close ties to any other VCT managers?
I wouldn't like to comment on the latter point as to whether Ruffer have close ties with other VCT managers. What I would say is that Ruffer were very supportive of our initial offer through the relationship Peter Dubins at Oakley had with Ruffer in his private equity funds. So it probably wasn't the normal sort of investment for Ruffer to put their clients' money into, but they did it on the basis that they were funding early stage businesses, which a lot of them liked the prospect of doing, and that they were getting a tax efficient investment. So, they've certainly, when I've presented to them every year, they've been very engaged with what we're doing, what the underlying companies are, and they've been a pleasure to work with.
Okay. Do they ever vote the shares that they hold, or the AGMs or anything?
Yes.
They do.
Yeah.
Okay. Can you tell us a bit more about the share buyback program? I think you announced it in the recent RNS or whatever, that you intended to embark on a share buyback program. Could you tell us a little bit more about how, when, what's your target in terms of discount? How you're going to do this through any particular market maker and those kind of questions?
Certainly. We are, our brokers are Panmure Gordon. We have a 5% discount to NAV policy. We will start our buybacks as and when we have liquidity to do so, which we will be using some money from future exits to be able to service buyback requirements, while also being able to pay a special dividend. So, I mean, we realize that it is it's very important for the VCT world to be able to have buybacks. Obviously, if you don't have the free cash, you can't do the buybacks, which is why we haven't done them in the past. We've gone out and invested the money. At the point where we have liquidity, we will obviously make buybacks. That is our intention, and we will recommend that to the board. Okay,
thank you. Just moving on to the performance fees. You've recently reset the performance hurdle to start at total return post-merger, which is apparently not the most shareholder-friendly option you could have chosen, but that's the way it's been offered. What guarantees can you give shareholders that you will not reset it again should the VCT underperform in the future?
Well, I mean, just from a standpoint of me personally, I don't want to be paying performance fees when I underperform. It's just not in our, we could have, if we'd wanted to, reset a performance fee to be based on NAV, which other managers do. And we could have, had we wanted to take a performance fee over the last few years, we could have turned around and certainly stated our NAVs rather than at a conservative level. We could have stated them at what we thought they were, obviously with guidance from our auditors. But we chose not to do that. So, I mean, am I legally bound by not to reset the parameters? No, but I just wouldn't do it. Simple as that. It's not, if we don't perform, we shouldn't be paid a performance fee.
Okay, that's good to hear. One suggestion on there is, or question should I say, why didn't you think about, or did you think about linking the 3p per annum to some kind of inflation-linked increment over time, as obviously that can change as if there is raging inflation in the pipeline, who knows?
We did try to engage with as many people as we could prior to going out to the market. We didn't want this to be something we tried to slip through unnoticed. We certainly, through Robin's meeting at City, took his advice to engage with yourselves. And as I said, we had a long conversation with Cliff and set out the parameters as to why we were doing it. I'm not sure there'll ever be a perfect performance fee that the market will say, well, that's perfect, because if there was, everyone would be doing it. Yeah. And it will be driven by shareholders. We wanted it to be simple and transparent. And we think we've got something that is simple and transparent.
Yeah, I have to say it looks quite simple compared to many I've seen. So I think these are probably relatively peripheral discussions at the moment. But if I guess inflation did take off in the future, there's always the opportunity to revisit it at some point anyway.
Absolutely.
Yeah. Just a question here, why charge more for direct investments than via an advisor? I suppose that's one that's often a curiosity to me. 5.5% versus 3.3% if one goes through an advisor. If I buy via Hargreaves Lansdown or Interactive Investor, do I pay 5.5 or 3%? Question mark.
I think not coming from a world of VCT, it's always been an anomaly that I haven't understood either. It's common practice. It penalizes direct investors, which is, I guess, there to protect IFAs.
Okay.
It doesn't advantage us.
Right. Okay. Yeah, I thought you might know, but I don't know either. So it's a fascinating one.
I mean, really. One of the things that I tend to do, Jeff Cornish, who is our promoter, really deals with all the what I would call more technical VCT fee structuring and stuff like that, because he's lived it for many years. Obviously, if there are any questions you want to get back to us directly with, then we will give you emailed answers. But it's an anomaly to the VCT world, and one that I have never fully understood, why we have to have this gap between direct and non-direct.
Right. Thank you. Well, the questioner there was Cliff Waite, by the way. So I'm going to throw that one back at my colleague Cliff at some point and say, well, Cliff, it's about time we talk to the industry about that. So try and get to the bottom of why it is that way. So it's one for the work list for Cliff in a way.
Thanks, Cliff, for throwing that one in.
Yeah. Just going back to the 40 million raise, that's quite a chunk if you look historically at what the sort of rate of investment that you've had in the past, and if you like, compared to the total NAV of the fund at the moment. Do you already have some cash on the balance sheet, by the way? Because the last set of accounts, I think you still had about 16 million or something. So that would be on top of that 40, presumably, as available for investment. But I'm sure things have changed since then.
We've currently got 9.
9. Okay.
We're currently deploying that. So we just concluded an investment yesterday in a company called Credentially. So we are currently spending money that we're raising, really.
Okay. Right.
So there is no cash drag. And the other point, which I think is very important, which because the way we've structured our team, and we have an investment team and a portfolio management team, it means that we can deal with the amount of deals that we've got. I don't have people who are multitasking across having to carry out early stage meetings, carry out due diligence, and then go and sit on portfolio company boards, because that's too much. And if people are focused in what they do, it makes it much easier. Now, we've also got an offer, because I don't like employing people before, obviously, and this is what we tell our companies, I touched on it earlier, I like being ready. So we've already put out an offer to someone who I believe has accepted the role, who's going to start in April, who's going to work with our investment team, because we know we're going to have more money. So there's now a necessity to employ another analyst. So we're ahead of ourselves in making sure we've got someone. We're not waiting till April to go out to market and find someone. But I don't need them sitting in a desk now. I need them in place in April. And the same on the portfolio side. So we will employ someone on the portfolio side to start April, May, as we take on more investments.
Right. Okay. Thank you. And out of that 40 million in your own mind at the moment, have you got a split there between follow-on versus new?
I would say it would be roughly 40-60 new to follow on, because we've got some great opportunities in businesses that over the last 18 months, we've put £1 to £2 million in that are no longer such risky companies. So it's really sort of in line with our strategy of roughly the way we look at it is, if an investment goes to plan, by the time we finish putting money into it, it will have 3 to 4 times what we first invested.
Okay, thank you. And quick one here, we keep on hearing that there is an increased interest in people starting businesses in recent years, and especially since COVID, maybe it's galvanized people into doing things differently and coming up with new ideas. Have you noticed any evidence of that?
Oh, huge. But not just since COVID. I think there's been a fundamental change in the job market, where when you look at, and I'm going to generalize here, when you look at an entrepreneur 20 years ago, entrepreneurs 20 years ago had on the whole failed at university. They hadn't gone to university. They had to go out and do something, whether that was become a self-employed plumber or start a business. But they generally went into a self-employed trade, set up a business. What we're seeing now is people's first choice is to become an entrepreneur. They don't, as a first choice, want to go and work for the banks and for the legal firms that maybe their parents did, because they saw what it did to their parents. They see people in this new world, in this Google world, having great offices, having great employers, having great freedom within their employment, and they want more for their lives. They want a better work-life balance. And even more so, what we're seeing is I'm seeing young people, I'm seeing my friends' children at the age of 16 and 17 talk to me about entrepreneurship. What is it to be an entrepreneur? They're starting really early. They're starting with these creative ideas. It's really great for UK PLC that we've got so many talented people who are thinking about setting up businesses, to the extent that even universities now are setting up hubs where they feel that these minds can collaborate to set up businesses. So all we've got to do is make sure that we keep them in the UK by being able to fund them.
Mm-hmm. Okay.
Hugely important at the moment.
Right. Thank you. Perhaps this is a bit of crystal ball gazing, this one, but do you see any of the businesses you presently have in your portfolio likely to get to the FTSE 100 level at some point in the future? If you had to pick one of them, which would it be?
Oh, there's a question. Something I've never really thought about. I don't think, well, I don't look at any of them getting to be FTSE 100. What I do see is companies being of significant enough size that they become worth hundreds of millions. Becoming worth billions at the stage where we back them. I think unless you're Alex Chesterman, who's a friend of mine, you know, it's not right. And actually, one of my pet hates is when founders come in and say, "I'm going to build a business worth 200 million in 5 years' time." It's just nonsense. Focus on the now. Now, some of them might get there. The reality is, more businesses fail than succeed. So they're up against it. But I mean, we've got some fantastic investments with some really great founders and management teams that continue to, you know, really knock it out of the park when it comes to performance. Okay,
thank you. Maybe just time for one more. I realise we're slightly over, but just one. I'll try and squeeze in the last one that's got some votes here. I think you've touched on most of this already, actually. What is your minimum targeted return for an investment? The sort of time period you expect to hold investments, and the targeted return on the whole portfolio. I guess it's a mixed bag in that sense, but you know, if you've got 1 minute on those, that would be good.
Well, so I think that slide that showed the greatest difference was the pre-2018 and post-2018 investments that we've made. We would look at an investment cycle being 3 to 5 years. Yep. Obviously, when we look at our early stage investments, they've been much longer than that because we were backing businesses that were doing, you know, £80,000 a year. We're now backing businesses that are doing $1 million a year. Right. Yep. At the point of investment. So that cycle, it on the whole, it takes as much time to get a business from 0 to 1 million as it does to get a business from 1 million to 7 or 8 million. Yeah. Okay. And when you're at 7 or 8 million, the funding circle opens up significantly. But our targeted return, I mean, people talk about targeted returns. We are a growth investor, and we want to, you know, return significant amounts of money to our investors. I don't want to come out with the number that, I mean, I think in our prospectus we put 3 to 5 times. I think, you know, that would be it would be a success. But I think more to the point, it's how we do things, how we recycle the money, how we take it from meeting the founders, investing, helping the business, exiting the business, and returning it to shareholders. It's getting that in a streamlined way. And I think it was Gary Player who said, the more I practice, the luckier I get. And it's one of those things that the more companies you see, the more founders you see, the more you see the ones that have really got something. And I'm sure, you know, you've seen Dragon's Den, where we all become experts on, you know, which companies we'd invested. You can very easily tell the ones that are credible and those that aren't. Yeah, yeah, very true. Okay, I'm an expert on Dragon's Den, yes. Don't get me started on that. Okay, Andrea, thank you very much for that. We've definitely got over time now. So I appreciate the time you've taken to spend with us this evening, and I'm sure our members do too. Lots of things to think about and take away. And I wish you well with you know, your growing team, and I hope that you manage to spend the £40 million that we've given you wisely. Thank you very much for having me, and thank you to all your members. All right, thank you. Bye for now. Thanks. See you again soon. Yeah. Bye bye. Okay, just a quick note before we leave you to enjoy your evenings and your dinners and everything. Just remember, there is a presentation and a recording will be on our website shortly if you want to go back and look at anything. And do provide some feedback. Click on the link in the chat box or the link in the email that we sent you earlier. And there you can see a list of upcoming webinars that we've got on for the next couple of weeks. A mixture actually of some masterclasses. Next one being the E in ESG, just telling you some of the things you should look out for
when companies claim to be environmentally friendly, etc. And it's a hot topic these days, which is going to get even hotter. Hopefully not as hot as the planet might get, or hotter than the planet might get. And then we've got a few company webinars in amongst all of that as well, and also another masterclass in mid-February with Steve Clapham, which is always an interesting experience, listening to Steve's vast experience of financial analysis. So do get along for that as well if you get the chance. So without further ado, I'll leave you to enjoy the evening. We'll leave the screen open for a while, just in case you want to go in the chat box and pick on one of those links, and hope to speak to you again soon. Bye for now.